Stop running and throwing your money down the drain. Many people have often told me, my credit isn't good enough, or I don't have enough money saved up. There's no way I could buy a house right now, especially with the prices being so high. However, most people don't truly understand what the criteria is for buying a home, or where they sit financially when they're even looking to do that. Most people are afraid to even find out. If you're one of those people, it's okay, but you need to watch this video before you take the next step. When I was growing up, I always saw movies or TV shows that gave me the impression that when you needed to get a loan for anything, you needed to get all dressed up, real extra nice, go walk into your local bank, sit down with the old man in the monocle, who's gonna barely give you any attention as you plead for their help to get some money. Then after barely hearing your whole story, the old man will put a big old stamp down on the application that says, denied. Well, I'm here to tell you that's not how it works, at least not anymore. It's 2024. I mean, come on, welcome to the age of tech, the age of doing everything we want the easy way. So when you're looking to get qualified or pre-approved, the process is super simple, and you don't even necessarily need to leave your bed to do it. As long as you have a smartphone or a computer, it's almost no effort at all. Most of the time, it only takes about a 5 to 10 minute phone call and filling out an application online in your own time. But having a good discussion with that loan officer will yield you more insight than you can imagine. But before you make that call, let's talk a bit about what most lenders tend to look for so you're a bit more prepared. Keep in mind, every lender you talk to is going to be different. They're not all built the same. Each one may specialize in certain services or products, and not all lenders can do the same thing. When one lender may not be able to get you a pre-approval, another might be able to, with a different product that they offer. So there are 4 main categories that most lenders tend to look for in order to issue a pre-approval for a loan. The first thing everyone likes to talk about, credit. Immediately, most people will jump to thinking about their credit score, and they'll look at Credit Karma or some other tool to try to see where that score is at. But I want you to bear in mind that these tools do not provide the full FICO score, or may provide a different type of score altogether. It's a great tool when you're trying to see where you are and where you're headed, but it's not the one you should rely on. Let your lender pull that for you. Your credit score may be the initial entry point to consider when looking at getting a loan, as there are many minimums required depending on the different type of loan, but often those requirements are lower than most people think. So each lender you talk to may have their own requirements, especially if it's set by a corporation. But I've personally seen plenty of my clients get approved with a middle FICO score as low as 580. For most FHA loans, VA loans, USDA loans, a 580 plus will at least get your foot in the door. For a conventional loan or some other types of specialty products, you may need to see a minimum of a 640 or better. As I mentioned though, score is just the first stepping stone regarding credit. The 2 other credit-related items that they look at are history and debt service. For history, it's most important that you have some amount of credit history, usually a year or better. The more, the better. But ultimately, it's important that you don't have any delinquencies or missed payments on your credit accounts within the last 12 months. Some lenders might be able to work around this. I have seen it before, but it's just going to be an extra hoop you're going to jump through. If you aren't familiar with what debt service is, basically it's just how much is your total minimum monthly debt payments on all of your credit-related accounts. That's the monthly payment you pay. I found that it doesn't so much matter how much total debt you have, but just the minimum you are required to pay on it each month. After all, when you get your mortgage loan, it's all about being able to afford its monthly payment, not some big lump sum. The next thing lenders will look at is your income and employment. They want to know, are you regularly, steadily, and predictably earning some kind of income? And what is that amount? If you are employed, they'll need to verify that you are actively employed and not a seasonal employee or being laid off recently. If you are a 1099 employee or a business owner, they will often use other means to verify this information. Typically, I've seen most lenders look at the recent 2 years worth of income statements, which includes your last 2 years of W-2s or 1099s, and they will also usually ask for the most recent 2 months of pay stubs. Sometimes they will ask for a letter of employment for verification purposes. But in the end, similar to credit, they ultimately want to know how much do you gross each month. So using the information from the 2 previous subjects, the lender can now determine what is the unsung most important part of getting approved. Number 3, the debt to income ratio. How much can they actually approve you for? They figure this out by determining that DTI, or debt to income ratio. Now, this isn't something you personally need to do. Your lender will do this for you. But if you're curious about it, it's a really simple formula. All you do is you take your total monthly required debt service and you divide it by your total gross income. You're gonna get a decimal amount or a percentage amount. Every lender is gonna have their own requirement of what that might be. but they will then take that number and find the gap between where you are currently at and where their limits are. This can range anywhere from 45 to 54%, depending on the loan product and the lender. And from there, they will determine how much can you get approved for. So the fourth and final thing lenders look into is what so many people I know seem to worry about nearly the most. But in my opinion, it's truly one of the least important aspects here, and let me tell you why. This, of course, is assets. In case you aren't familiar with what the bank thinks assets are, no, it's not your car, your boat, or your Gen 1 Pokemon collection, but it's defined by items that are easily liquidable and can show value immediately. This includes your current bank statements, such as checkings and savings accounts, as well as retirement accounts such as a 401k, annuity, IRAs, and sometimes even pensions if you can draw from them. It would also include any stocks that have value that you currently hold and could easily sell for real cash. Ultimately, there's no specific hard number that they need to see here, but a flexible one depending on your loan product. They would like to see if you have money for the down payment, which can be as low as 0% or 3.5% down depending on the loan type. They also want to know if you have the closing costs, which can vary from lender to lender. You could estimate this to be between maybe 2 and 4% of the purchase price on average, but I would suggest that you talk directly to the lender to find out what some of their costs may be and how best to prepare for them. On occasion, lenders may also require that you have some additional funds in reserve after closing, because they don't want you spending every single dollar you have to get to the closing table and then be suddenly faced with a deficit and unable to make your first couple mortgage payments. This is not always a requirement, but sometimes it is based on the risk factor. The reasons why I feel this is actually the least important topic is because of the following. Number one, this number is largely determined by the sometimes flexible percentages of what you plan to put down based on the purchase price of the home. Number two, there are sometimes opportunities for your realtor to negotiate seller concessions into the deal where the seller actually helps to pay some of your closing costs. Number three, there are a handful of different programs and products out there that can actually help provide down payment assistance, sometimes based on the percentage of the purchase price or a fixed amount like $10,000 for example. Please check with your local lenders to find out what some of these may be and who offers what. Lastly, you also may have the opportunity to receive what's called gift money or gift funds from a relative or friend who wants to help support you and see you succeed with the purchase of your new home. The important part of this to remember is that a gift letter will be required. This is gift money, not a loan or borrowed money. The whole point of this is that you don't have to pay this money back. And it's important to talk to your lender about this before you do it, because they'll want to keep track of every dollar spent. Remember, the process of getting a pre-approval allows us to get your foot in the door so you can start shopping for that first home or your dream home for you. It's not the 1920s anymore, it's 2020s. Let technology and simplicity be your friend. Don't hesitate to reach out to me if you'd like some more information on this or a referral to one of my fantastic lending partners. If you enjoyed this video, make sure to hit the like button and smash that subscribe button to stay up to date on all of my future videos. Thanks for watching, and I'll see you in the next one.